Thank you, Lauren. Thanks to Lauren and UBRI for inviting us to present here. Thanks to all of you for sticking around. It's been a long but really exciting day of research and ideas being shared. And so grateful for this opportunity. As Lauren said, I'm an economist at the Tepper School of Business at Carnegie Mellon. I'm also a co-director of our university-wide blockchain initiative. And I'd be remiss to just say I want to take a moment on behalf of all of our blockchain faculty and students to thank UBRI for their amazing support and partnership over the years. It was really a catalyst that supported a lot of the research and educational efforts we're doing across campus at CMU. So what I'd like to do today is share a little bit about some recent research coming out of this collaborative, basically taking a first principles economics approach to understand liquidity, how to efficiently provide liquidity in decentralized financial markets, okay? So, economists like to go back. So, in the beginning, okay? What do I mean by that? Well, if we're gonna talk about liquidity, let's start by asking what is liquidity? And it starts with understanding that people want to trade. And for people who own digital assets, there's enormous demand to trade these digital assets. In spirit, there's an idea that crypto could be used as a medium of exchange to buy goods and services. We don't see a lot of that, but we do see a lot of other types of trade. We see a lot of people trying to borrow and lend against their cryptocurrency, trying to adjust the timing of when they own or have access to their crypto. We see people trying to adjust their portfolios as ways to improve risk sharing with each other. Probably the most obvious way we see trading is people, it gets a bad name sometimes, but we call it to speculate. What do I mean by this? People, for very natural reasons, I think, have very different opinions about the value of their different cryptocurrencies. There are a lot of network effects baked into what crypto might be worth. We can all agree to disagree on which crypto we think might be valuable, and that's fine. But economists well understand that when people have differences of opinion about the value of assets, there might be gains to trade, to reallocating to those assets to the people who most value them. And so then where liquidity comes in is how do we actually trade and exchange these assets? In an ideal world, my computer science colleagues tell me I can't talk about blockchain or crypto without Alice, Bob, and Charlie. So, in an ideal world, Alice and Charlie meet. They each happen to have an asset that the other wants. They have a double coincidence of wants. They're in the same space at the same time. They just swap their assets. Life is good. In practice, this never happens, right? They're separated. Here, for example, Alice and Charlie are separated across time. So how do they possibly trade these assets when they're distant in some notion? And the answer is someone has to make a market for them. Let's call that Bob. Bob is our liquidity provider, okay? And conceptually, what could happen? Alice and Charlie could, over time, warehouse their assets with Bob and trade, in some sense, some kinds of liabilities against Bob with each other over time. Bob makes a market for them. Okay? So how does this work in practice? Well, broadly speaking, for digital assets, there are two kinds of quote-unquote Bobs. There's a conventional type of financial market, a centralized exchange. Big players, obviously, Binance, BitMEX was early on a big player. Another one, maybe we don't need to mention today. Okay? And what happens when you trade on a centralized exchange? It's like my Bob example. You send your store of value to the exchange, and what you get back is a liability, an IOU of the exchange. And from that point on, you are transacting liabilities of the exchange. Where do those transactions take place? On a ledger kept solely by the exchange. And that works as long as you believe the exchange has a ledger, not 8. It works as long as you believe the exchange's ledger is actually correct. And with digital assets and the nature of where these centralized exchanges supporting people who want to trade digital assets tend to be, it's not surprising people have a lot of concerns about whether they can trust these centralized exchanges. And so what has emerged over the last several years is this alternative type of exchange, a decentralized exchange or DEX. These look quite different from traditional exchanges. The key leading examples are Uniswap and Curve. On these exchanges, all trade takes place via a smart contract. All transactions take place on the quote-unquote blockchain ledger, if you will. I'll come back in a minute, but as we've heard a few times today, there's active debate and voting going on now to bring this type of decentralized trading protocol into fruition on the XRPL ledger, okay? I think that there are interesting questions that emerge on XRP relative to other blockchains that I'll come back to in a moment. So I find this a really big deal we need to better understand. What are the differences between these types of exchanges? So let's start with a centralized exchange for a minute. On a centralized exchange, all orders and trades take place inside the quote-unquote computer or centralized ledger of the exchange. Conventionally, these look like central limit order books. Traders come to the exchange and they post an order. They sign a direction, I would like to buy or sell an asset. They sign a quantity and they sign a posted price. Once you observe all the posted bid and ask prices, buy and sell orders, there's an engine that tries to match them according to some priority rule. You match buys and sells, and there might be some time priority going on. This picture is a little small, I apologize, but if you look at this list of numbers, what you're seeing are a bunch of ask orders and a bunch of bid orders. People posting prices they want to sell, people posting prices they want to buy. If you aggregate all of those up, if you squint, you can kind of see this curve. What you get is an effective price function that emerges from all of these messages. If I would like to buy assets, I have to walk up from the mid-market price and start buying assets. And the more I want to buy, the higher the prices I'm going to face. And if I want to sell assets into the market, I walk down, and the more I want to sell, the lower prices I want to face. What emerges is an endogenous set of prices for different quantities you want to trade. It comes out of all of these messages posted to the single ledger of the centralized exchange. Now, when you think about trying to implement this on a blockchain, I've done it in class. It doesn't work. You just try it naively. It's not going to fly. And why is it going to fly? Well, on most blockchains, one, there's a latency problem. When you try to post messages, it takes time for messages to get encoded into the ledger. Two, it's really expensive. Every time you want to change the state of the ledger, you pay a fixed transaction cost. And on most chains, that transaction cost is high. This isn't an execution cost. This is, I'm posting a request to buy an asset. You're changing the state of the ledger. That costs you money. It's impractical. It doesn't work. On XRP, it's kind of practical. So it's kind of fascinating. XRP says, we're just curious. Does this new way to make markets work better than the old way to make markets? On a decentralized exchange or an automated market, all orders and trades happen on-chain via smart contracts. You start by embedding an ad hoc pricing function, call it G for the minute, into a smart contract. Once you do that, that defines the prices people can buy or sell tokens with the contract. How is priority determined? Chain-based priority. You look at the way in which transactions hit the chain, those get executed first. That creates scope, at least on Ethereum, for miner extractable value. You could take advantage of your ability to reorder transactions to kind of take advantage of some of these trades. So you start understanding there might be trade-offs of these two different approaches, might be more or less feasible on some chains or others. Our goal is really to take a dive into this from an economic view and understand where might there be value, how do we efficiently offer liquidity in these markets. Okay. These are just a picture of Uniswap and some DeFi markets. There's a lot of innovation happening here, and so we want to provide some economic guidance. So let me be precise. How does an AMM work? If you are a quote-unquote liquidity provider, you have a portfolio of tokens. Let's call them A and B. If you like, think of A as Ethereum and B as USDC, some stablecoin. You send a bundle of your tokens to a smart contract. Call that bundle QA and QB. Later on, a liquidity taker, a trader, will come to your smart contract, meaning they'll send a transaction to the blockchain, and they might say, I'd like to buy or sell some quantity of token B, USDC, from the contract in exchange for QA tokens. And that price function embedded in the smart contract G tells them what those prices are. It says, if you would like, let's say, to buy QB tokens from my contract, given my pool has big QA and QB in the pool, this is how much of QA you have to put in. These ad hoc functions are just specified into the contracts. So some obvious questions. If you're thinking about supplying liquidity, how should you do it? What deposits should you make? Uniswap has some guidance. Everyone follows it. Is that good? Where does that come from? Can we evaluate it? Second, how should this G be designed? It turned up in Minecraft like 12 years ago. Vitalik proposed it in a blog post, and now it's everywhere. Is this good? There's a lot of innovation. Uniswap's going through a lot of iterations on how to tweak it. Very little first principle economic analysis. How do we maximize gains to trade in this market and make it function efficiently? Okay, so that's what this research is trying to do. Can we develop a simple, tractable economic framework to get at some answers? What I'll focus on today is I'm going to evaluate this conventional wisdom. The conventional wisdom is if you're going to deposit 1 unit of Ethereum, you should deposit whatever the dollar price of Ethereum is in terms of USDC into the pool with it. Equal value portfolios. I'm going to argue to you that's probably not good advice. That if we could re-coordinate everyone to a different deposit, we can provide better liquidity services. Okay? And then I'll give you some views on the optimal kind of design considerations. I got to start moving. So I'm not going to give you any math today. It's the end of a long day. Economists are storytellers, so I'll stick to a story. Here's my story. Why are you providing liquidity? You've got a portfolio of tokens. Why would you lock them up somewhere and let people trade against you? Well, my idea is you're just some passive liquidity investor. You don't really have a thesis. You can't get chain priority. You kind of know if there's some high frequency movement. Lauren's way smarter than me. She's going to beat me to the market wherever it is and take advantage of that before I could do it. I just have this stuff that's sitting around. Maybe I can earn something on it. Who are liquidity takers? These are the Laurens of the world, right? The sharks. They're the ones who know how to high frequency arbitrage stuff, know how to get chain priority. They're going to come at me, okay? But I'm going to make a simple assumption to make this market kind of interesting. I'm going to assume these active investors come in 2 types. One type of active investor, in a classical finance setting, we call them uninformed or noise traders. They just have some need to trade. And their need to trade is orthogonal to anything going on with the value of the tokens. On the other hand are the real sharks, the ones who are informed. They know something's happening to the value of tokens. Their beliefs are actually the same as mine, but they're moving before me. When people talk about impermanent loss, they're often talking about this. There's an event. People are trading against you in the automated market. If you'd not done those trades, given the way the price has moved, you'd have been better off. So we're capturing the spirit of that with these informed trades. And so now I want to explore the trade-offs of providing liquidity and how we can affect them. Okay. Again, what are the mechanics in my model? This is just one equation. Don't let it scare you. It's just defining prices. Again, the liquidity provider says, I have some tokens. I get to choose how much to send to the pool. And what I'm going to argue to you is that choice of how much to send to the pool is going to affect the kinds of prices liquidity takers will face when they come to the market. And I'm going to think about how that decision affects the kinds of trades that we'll realize. Once I do that, the liquidity taker, they're faster than me, gets to move. Okay? They're going to learn something and they're going to want to trade, and we'll see how it matters if their trades are informed or uninformed. And to make this precise, I'll follow Vitalik's suggestion. I'll use this constant product rule, which says if I have deposited as a provider EA and EB into the pool, and someone wants to come and withdraw QB units from the pool of token B, they've got to deposit QA in a way that keeps this equation intact. What that does is it defines this hyperbolic curve you've seen if you've Googled anything about a DeFi market. Okay? So at the end of the day, certainly a picture is worth 1,000 words. So here is everything I think you need to know about the economics of DeFi automated markets in one graph. On the x-axis, I have quantities of token A. On the y-axis, quantities of token B. The liquidity provider chooses how much liquidity to put in the pool. That's those quantities EA and EB. There's 1 point. That's where we start. Any trades by any liquidity taker are going to move our liquidity provider up and down this curve. Liquidity provider is always going to end up somewhere on this curve. That's the definition of the function we ad hoc specified. Again, what is the liquidity provider's decision doing? It's moving the position of this curve around this plane. And we're going to try and understand how should they make that decision. To do that, we have to understand where will they end up. Okay? What is important about their choice is this choice of a deposit point pins down a relative price between token A and B on the margin It's a nerdy economic word, right? For a marginal trade in one direction, that pins down the relative price the liquidity taker will face. How do you interpret that? If the liquidity taker, again, imagine token A is Ethereum. The liquidity taker is coming and saying, I want to sell 1 unit of Ethereum to the pool. I want to push the pool 1 unit to the right. That slope tells me how much USDC can you withdraw. That slope is effectively the price that you can sell 1 unit of Ethereum to the pool at. Now, what happens as you sell more and more? That price starts going down. Okay? You want to sell 1 unit to the pool, you get to take out less USDC from the pool. It just naturally slides down the curve. Prices get worse for the liquidity taker the more they want to take out, just like the central limit order book. It's naturally appealing. It has the same flavor. So it's not surprising we got here. So what is our liquidity taker going to do? Well, I started by saying, I think speculation's not bad. People can have differences of opinion. So imagine the liquidity taker comes along and says, I don't think this Ethereum stuff is really worth much. What does that mean? That means they'd be willing to sell 1 Ethereum to the pool for like a fractional amount of USDC. Their relative value is a flatter line than the relative price on the margin that the pool defined. So how does that liquidity taker look at this? They say, this pool is giving me a great deal. I'd give up an Ethereum for 100 USDC, but the pool's giving me 200. What should I do? Sell into the pool. They start selling into the pool, and what happens? This price, my blue slope, starts getting flatter and flatter. But as long as it's steeper than this liquidity taker's relative value, the liquidity takers say, great, I'm going to keep selling into this pool. When do they stop? They stop when their beliefs, the relative value of these 2 tokens, equals exactly the relative price offered by the pool. Okay? That's where we end up. Now, is the liquidity provider happy about this or sad? Well, it depends on what they think. Is this liquidity taker showing up for reasons orthogonal to my beliefs? They think Ethereum's worthless, but I still think it's really great? If that's the case, my beliefs are back at my original prices. What has this liquidity taker done? They've come along and sold me a lot of Ethereum at what I view really favorable prices. Notice, there's no problem here. This is economically valuable. The liquidity taker thinks Ethereum is not worth much. I think Ethereum is worth relatively more. They've just given me a bunch of Ethereum that I value, and I've given them USDC that they much relatively value. This is economic gains to trade. This is why this market exists in the first place. We are matching people with different opinions and allowing them to maximize their gains to trade. What could go wrong? What could go wrong is, well, maybe this person's trading for reasons correlated with my beliefs. Maybe there's some news event in the world. We both agree Ethereum is not worth very much, but I can't pull my liquidity because I'm slow. I'm not Lauren. What happens in that case? Well, if my beliefs are actually flat, just like the liquidity takers, I've now sold a bunch of Ethereum at what I think is a discount. I'm worse off. So how does this market function fundamentally? And I actually believe this. I don't know. How many of you have done an actual AMM trade? Like a couple? Do we think everyone trading in these markets is perfectly rational arbitrageurs doing high frequency across every possible exchange? Like, I'm sorry, people like doing this on Dogecoin? No, like they're just buying random stuff. There's a lot of orthogonal trade. There are also informed trading events that are costly. These markets work by balancing profits on uninformed orthogonal trades against losses from informed trades. This is a canonical form of adverse selection in financial markets. We normally consider it in a limit order book. If I'm posting an ask price where I want to sell an asset, I have to ask myself, why is Lauren buying the asset from me? She must know it's pretty good, and so I better charge a higher ask price because I might be selling it at too much of a discount. Here, I can't change the price because this function is given. What can I do? I choose my quantities. So the question now is, I've explained to you how we model these trade-offs. I want to make money on uninformed trades. I know I'm going to lose some money on informed trades. How do I choose my deposits to balance those? What do we find? If you're a liquidity provider, how should you behave? In math, this is how I would say it. You want to deposit an equal expected value. The returns on the deposit of token A should be equal to the returns you expect to get at token B. Or the price value of token A should be the same as B. I have a problem with this notion because I don't know how to define the price of like a cryptocurrency. There are like 500 prices I can find in the world. So I prefer to define it in terms of my value of the token should be roughly equal. In the paper, we show this is generally not true. In general, it is more efficient for liquidity providers to offer different ratios of liquidity. And why is that? It allows them to facilitate more gains to trade on uninformed trading outcomes. Adverse selection, it turns out, distorts it. So I can recover Uniswap's guidance if I assume adverse selection is so severe. There's so much informed trading that there are no gains to trade in the market for liquidity. But I find that a bit perverse. That says this market shouldn't exist. If it exists, Uniswap has it right. If it should exist, I think we can do better. We can extract more rents, more gains to trade overall, more surplus in this market. Let me just tell you 2 more results as a preview. We're going to post the paper online shortly, and then I'll wrap up. Volatility in crypto markets changes a lot over time. So you might ask, as you create more risk, is this good or bad news for liquidity providers? On the one hand, if there's more room for differences of opinion, there's more room for gains to trade to be realized, I can provide more liquidity. We can get more intermediation in these markets. On the other hand, I know it's trite of an economist to say one hand in the other hand, but on the other hand, what happens? There's more difference of opinion, there's more loss from informed trading. So it's not obvious which way dominates. We actually show you could get both in the paper. If we put in some numbers, roughly speaking, to match crypto markets as they are today, it seems like gains from uninformed trade benefit the market more. So as risk goes up, profitability of liquidity provision goes up. You should see more intermediation volume, more gains for liquidity providers. And the last results we show here are also a bit subtle. We consider the shape of that price function G. And so what we consider is trying to flatten that price function to make it more linear. Okay, what happens if instead of having so much curvature, you flatten it out a bit? And what we argue is that if the set of possible token valuations are not too dispersed, not too wide, then making this price function more linear creates more trade, which is beneficial for everybody. However, if you tolerate very possible extreme beliefs, then this adverse selection I've been describing, this fact that you might be trading with informed traders who are trading against you, can be quite costly. And so that says there's value in this convex shape in that G function that Vitalik proposed. And so we're showing there's an optimal amount of convexity in this function, which maximizes the amount of liquidity that can be provided in this market. Okay, let me wrap up. For this whole decentralized finance experiment to work, we need well-functioning, quote-unquote, markets. Our notion of markets on a distributed, decentralized ledger looks quite different than a conventional market for a variety of reasons. And so part of the goal of this research is to kind of understand and develop a new market microstructure of automated decentralized markets. We think this is as important as security practices, making sure these smart contracts are designed, audited, and working correctly. We argue passive liquidity providers can trade off gains from what I'll call idiosyncratic uninformed trades against the losses they derive from information-driven episodes. And we argue that allocative distortions that emerge in these markets kind of have the similar flavor from traditional limit order books, but they manifest in new ways given the new structure of these markets. Let me wrap up there. Thanks, everyone.